Welcome to the fourth session of module issue of shares and debentures. In the previous session, we have studied on the concept of calls in arrears and calls in advance. In this particular session, we are going to discuss simple problems on issue of shares and simple problems on allotment of shares. The learning objective of this particular session is understanding the accounting treatment. How journal entries will be made and in the books of accounts when company issues shares and when company allots those shares to the public. To start with the simple problem on issue of shares and allotment of shares, the problem goes like this. Here, issue of shares at face value. Assume that company is going to issue shares at face value and shares are undersubscribed. Less number of shares are subscribed by the company out of shares which are issued by the company to public. A limited company issued 10,000 equity shares. This is issued capital. 10,000 shares are issued by the public company to the public for subscription at the rate of 10 rupees each. And the money was payable as under 2 rupees on application stage, 3 rupees on allotment stage, and remaining 5 rupees on first and final call. Only one call is made by the company, that is at the rate of 5 rupees. Though companies issued 10,000 equity shares and people have subscribed, public has subscribed only for 9,000 shares. This is called subscribed capital. 9,000 shares are called as subscribed capital. All the shares are allotted and the money is duly received by the company. That means since number of shares subscribed by the company is less than the shares which are issued by the company, all the shares will be allotted to the public and the money will be received from them. But in this particular problem, all the shareholders have made all the payments without any arrears. Let us see how these entries are made in the accounting books regarding issue of shares. The first journal entry which we make at the time of issue of shares is the application money, regarding application money. Bank account debited, since money is coming in, bank account is debited and equity share application account is credited. On 9,000 shares at the rate of 2 rupees each, 9,000 and 2 rupees becomes 9,000 into 2 rupees becomes 18,000. That's therefore 18,000 debited and 18,000 credited. There is an alignment problem, and debit and credit. Next, second journal entry is regarding transfer of application money to share capital account. In such case, share application account debited with same 18,000 rupees which is received by the company to share capital account. The third journal entry is regarding allotment money due. This journal entry shows allotment money is due. Allotment money is 3 rupees per share. On 9,000 shares becomes 27,000. Therefore, equity share allotment account debited to equity share capital account, 27,000 debited and 27,000 rupees credited. And the fourth journal entry is this allotment money will be money is received by the company from shareholders to whom shares are allotted. Therefore, bank account is debited and share allotment account is credited with the same money. And fifth journal entry is regarding call money due. The call money is 5 rupees on each share on 9,000 shares. It becomes 45,000 rupees. So equity share capital account, equity share call account debited to equity share capital account, that is 45,000 rupees debit and 45,000 rupees credit. This journal entry indicates that call money is due from the shareholders to the company, and the last journal entry shows that call money is received. So hence journal entry is bank account debited to share call account, 45,000 debit and 45,000 rupees credit, being share call money received. Here in this particular problem there are no calls in arrears and no calls in advance. Thank you.